Hey everyone, welcome to Chip Stock Investor. Just Nick today. Casey's got other obligations. Hey, so we've been talking about Fortinet over on Semiconductor Insider. Check that out at chipstockinvestor.com. But since Fortinet is one of our top cybersecurity stocks and just one of our top investments overall, top portfolio holding for us, we thought we should probably do a quick update given the post-earnings turmoil that cropped up last week after Q2 2025. Let's dig into what happened and specifically one point that we think is the real reason why Fortinet just got re-rated to the downside. This is our cybersecurity industry end market chart, bubble there in the middle, highlighting the expected annual growth of about 12% over the next 5 years or so. And the biggest portion of this, of course, network and cloud security, which are very closely related. And as we've pointed out before, we actually file Fortinet under the cloud and enterprise end market because they make firewalls, servers that control the flow of data into and out of a location. Now, that could be traditionally a branch office, a retail space, manufacturing facility, some other physical footprint, or it could be traffic moving to and from a data center, one either operated and owned privately by a company, its own data center, or one in the cloud. And there is a refresh cycle currently underway for a lot of these traditional firewalls. In addition to that, Fortinet does design some of its own chips. They call them the SPU, Secure Processing Unit. And of course, there's a lot of AI that goes into the algorithms that those SPUs run. So we've always called out Fortinet as something of a pretty unique player within the cybersecurity world. And historically, this is because Fortinet has all of this networking hardware that they converge with cybersecurity, which puts them in competition with a lot of traditional networking companies, in addition to some of the other network security players like Palo Alto Networks, Check Point, Cisco, and so on. And after Fortinet lands that hardware sale, over time, they get to turn on the security and services, the recurring portion of the revenue. And that has been a really good go-to-market strategy for the company for a long time now. And we are in the midst of a bit of an acceleration because of that network hardware upgrade cycle. You can see billings growth actually increased to 15% year over year in the last quarter. Unified SASE meaning Secure Access Service Edge billings also up nicely, and their security operations software up 31% in billings, leading to total revenue growth of 14%. Right around what we were expecting for the second quarter. And here is the quarterly revenue breakdown. In red and orange are those security and service revenues, a lot of those tied up with long-term contracts after the company sells the hardware. That would be primarily product revenue in blue there at the bottom. And you can see the nice year-over-year increase in those product sales driving the security subscription revenue there at the top of this chart. This slide here from our friends over at fiscal.ai. We have a number of their charts in today's video for Fortinet, and they are the sponsor of today's video. If you want to make great financial visualizations like this one, check out our link, fiscal.ai/CSI. That gets you also 15% off any of their paid plans. Check it out. Amazing platform that we use every day here at Chip Stock Investor. And as we've been talking about for over a year now, that SASE service that Fortinet has been building out continues to grow nicely. Total annualized revenue for that reached $1.15 billion in Q2 2025. And then also the ARR in security operations software, also nice annualized growth rate in Q2. So what exactly was the problem for Fortinet this quarter? If you're looking for a reason why the stock fell after Q2 earnings, we think this sums it up right here. The big blue bars is Fortinet's cash from operating activities, which just in absolute terms increased to 452 million, up a really impressive amount from 342 million in the same quarter a year ago. But the problem is, look at the big increase in CapEx, purchase of property, plant, and equipment. They're in red at 168 million, and that effectively sent free cash flow on a per share basis tumbling back down almost to a multi-year low point. You can see this play out on an even longer term basis here. We've gone back 7 years, and in fact, free cash flow per share, you can see, has gone all the way back to where it was some 4 or 5 years ago during the pandemic era. Not a great look. What exactly is going on here? Up until about 6 months ago, we had been showing you this chart from Google Cloud showing all of their data center locations around the world. And that's because Fortinet has been building out that SASE service, which is a combination of hardware and data center infrastructure delivered service paired with a bunch of software-driven security services, to put it in very simple terms. And Fortinet has been building out that SASE service using points of presence, utilizing Google Cloud data center locations. Basically, what that means is Fortinet has been using Google Cloud data centers to build out those services close to its customers. But about 6 months ago, Fortinet started showing this slide, and those blue dots roughly correlate to the points of presence in the Google Cloud chart before. But now in red are Fortinet's own data center assets that they are building themselves. So in addition to providing networking hardware full of their own customized silicon, Fortinet has what could be another major differentiator from the other cybersecurity companies out there, that being actual data center real estate, actual data center infrastructure that they're using to process some of their customer data. Now, the reason for this ultimately is Fortinet processes a lot of information, one of the largest cybersecurity pure play companies on the planet. And so they think over time, this is going to be a very cost-effective model for them to be able to own and operate their own data centers to process a lot of that information and to operate some of their expanding lineup of software-based services. For example, we have this quote from CEO Ken Xie from the last call about 3 new services in the Fortinet ecosystem: FortiIdentity, FortiDrive, and FortiConnect. Specifically, FortiIdentity, you may recognize that identity services as a big area of growth for cybersecurity software. Palo Alto Networks just announced its plan to acquire CyberArk, one of our smaller cybersecurity portfolio holdings that we called out in 2024. So ultimately, whatever the software may be, it has to operate somewhere. The customer data needs to be processed somewhere, and Fortinet thinks that owning some of its own data center assets will give it a good cost structure over time. It will be able to control its expenses much better than fully relying on co-location services from partners like Google Cloud, which, importantly to note, operates a lot of its own cybersecurity services. So these big data center operators, the hyperscalers, Google Cloud, Azure, AWS, all competitors to companies like Fortinet. And besides just cost control, Fortinet believes this can help them differentiate their cybersecurity service as well, perhaps offering a greater degree of security versus some of their peers that offer a SASE service but rely wholly on the infrastructure of the hyperscalers. But this is, of course, going to cost some extra money. So this slide Fortinet provided us on the right, their adjusted free cash flow. So if they've further adjusted the adjusted non-GAAP free cash flow metric to show what they spent on real estate or data center investments in Q2 2025 for comparative purposes. So if you were to back out those one-time real estate investments in the data centers, that was 144 million in Q2. Free cash flow would have otherwise been 428 million, just over 100 million year-over-year increase from $324 million in Q2 of 2024. Of course, we can't do that. Real estate investments are very much a capital expense, so we can't add that back. So the ending free cash flow was indeed $284 million in Q2 2025, a significant decrease from a year ago. But nevertheless, they were kind enough to show us what amount they paid on one-time purchase of real estate for comparative purposes. And this is the reason we believe the market re-rated Fortinet to the downside. We have a new type of capital expense going on. And whenever there's new elevated CapEx, a company is making a foray into a new domain, there's risk that the investment may not pay off. And so the stock price has to reflect that. Nevertheless, Fortinet did still have a good earnings report. They essentially reiterated their outlook for full year 2025. They narrowed the range of revenue down by about $25 million, raised it on the low end and lowered it just a bit on the high end to a new range of $6.675 billion to $6.825 billion. Implies year-over-year growth over 2024 of about 13% at the midpoint. They did slightly increase their adjusted non-GAAP earnings per share by just a few cents as well this quarter, but all this is fine and well. The overarching theme here was indeed the concern over the future payoff of these investments. Can they continue to grow at or near the overall cybersecurity industry growth rate of a low teens percentage? So their billings would seem to indicate that they still are. Expectation for full year 2025, billings and revenue growth still at around 13%. But more importantly, as they build out and operate these data center assets, can they continue to maintain that operating leverage, increasing operating profit margin? Here is the GAAP unadjusted operating margin for Fortinet over the last decade. Really fantastic. Up and to the right progress, with the exception being 2020 and 2021, lapping some effects of the pandemic and lockdowns. But overall, even so far this year, in the first 6 months of 2025, more margin expansion for Fortinet. Can this continue? Management thinks that investing in these data centers, that they can continue to grow their revenue and the operating margin will continue to rise. Last slide here from fiscal.ai. The new uncertainty around these new investments needs to be factored into the valuation. And so on a trailing 12-month basis, we got the re-rate to the downside. The stock now trading for about 28, 29 times both GAAP earnings per share, trailing 12-month GAAP earnings per share, and about 28, 29 times trailing 12-month free cash flow. So what should you do with Fortinet? When we talk about these businesses, unless we state otherwise, we're invested for the indefinite future. We see no reason at this particular point in time to panic on this one and change our thesis. In fact, what we see here is a company that's recognizing good return on investment, especially with that SASE service that they continue to build out and other supporting infrastructure for their other software, and getting into the data center market, at least a bit, dipping their toe into the data center market while continuing to rely on partners like Google Cloud. And the company has a great track record of getting above average return on invested capital. So at this point, we're content to leave this alone. This has been a huge market outperformer, a huge driver of our portfolio performance, coming up on nearly a decade now. And in fact, I think we will probably be taking a nibble again on this stock in the next few weeks for the first time in a while, that we'll be adding to our Fortinet position. Happy with the progress that we see here. And until we see a reason to be worried about those investments in data centers, we're going to leave this one alone so that CEO co-founder Ken Xie and the team can do their thing. That's a wrap for this update of Chip Stock Investor. If you want more discussion on Fortinet with a community of other like-minded long-term investors that like to dig into the nitty-gritty of what's actually happening with the business, join us over on Semi Insider. You can check that out at chipstockinvestor.com. Also, check out the blog and sign up for our weekly newsletter if you want a taste of what Semi Insider is like before you sign up. Take care, everybody. Thanks for watching. We'll see you again later this week.